ISM non-manufacturing PMI below 50. That was notable. The lowest ADP print in more than 2 years, notable. Yields falling, something to keep an eye on. The president, once again, all over the Fed chair to cut rates. ADP number out. Too late, Powell must now lower the rate. He's unbelievable. Europe has lowered 9 times. At the same time, Joe, the president says it's extremely hard to make a deal with China's President Xi. You have the drama over the tax bill. You have the Musk versus Republicans on the Hill now. Ray Dalio on CNBC earlier today agreeing that the debt's a big problem. Nothing new from him, of course. He said, quote, "We're going to be in a period of greater than normal risk," citing a number of factors for that point of view. And yet the S&P is 2.5% from a new high. And I think our viewers care more about that than any of the other surrounding noise, I dare to believe.
I would agree with that. And everything that you're identifying is going to be featured on the next episode of how the market continues to move higher. Because in the current episode right now, the market is running off of a rebuilding of sentiment and positioning. And that is absolutely what is driving the market in the near term. What you've identified, the concerns that are in front of us, the concerns surrounding, absolutely, there is a hesitancy to transact. That was clear in the month of May. It is reflected in the services. It is obviously reflected in the ADP report. And tomorrow we're expecting 130,000 jobs in the May report, down from 177 in the month of April. I think we're going to see that there as well. So in the near term, the market has the ability to move towards the all-time highs. I acknowledge that. But I do see in the third quarter, there is difficulty ahead, and it's related to an economy that is going to cool. And I've said this for the last several weeks. My biggest concern is not inflation. It is growth. And I am concerned that growth is slowing rapidly.
Well, and I guess you have to be concerned that the tariffs are the contributing factor or the leading factor as to why growth would be slowing. You know, I don't know what you guys think about what the future of the tax bill means to the future of the market.
I think it means a lot.
How are you thinking about that?
Here's my opinion, and we wrote this at Cerity Partners. It's up on our website. That the CBO, the Congressional Budget Office, which scores this thing, says it's going to be $2.4 trillion over the next 10 years, $240 billion a year in deficit increasing. But there's two things that are left out of that. One is the fact that the CBO does not do dynamic scoring. It doesn't take into account any economic growth that may come from this. We're of the opinion that there will be economic growth that comes from this.
Well, the other side of this equation, I'm sorry to interrupt you.
Are you going to steal my thunder?
I'm sorry to interrupt you, is that they also came out, because Megan Casello was doing this reporting earlier and saying that they said that the tariffs would cut the deficit.
Exactly. Thank you.
However, okay, let me finish, because there's a big asterisk by this second one. They say it would cut the deficit, the tariffs would, by $2.8 trillion over 10 years. So let's just call it a net zero. That is assuming, of course, that the tariffs are in place for 10 years.
Yeah.
Anybody believe that you're going to have tariffs in place for 10 years?
I hope not.
Well, listen, wait a second.
You're even debating that they could be?
No, I think, 10 years. I mean,
That's what they said.
I know.
That's
and
what the scoring is based on.
That is what the scoring is based on. I mean, I think all of us on this desk and the ones who are not here today will admit that it's a difficult job to predict what the rest of this year is going to bring, let alone 10 years. We have to deal with the cards as they're dealt, and you just showed them to us, Scott, and that's what I was going to say is that right now in the month of May, tariffs ran at an annualized rate 190 billion more than a year prior. That's just a fact, okay? So that 190 billion up against the 240 billion of deficit increasing, again, not dynamically scored from the deficit. I call it a wash. Will it last? I don't know. I don't know if the tariffs will last. And I think, frankly, what I'd like to see before we discuss whether they last through next year's midterms is let's get them in place and move forward. This economy, this world wants to know what the rules of the road are, corporate-wise, investing-wise, and move forward.
It still leaves you, even if it is a wash, it still leaves you with the current state of the deficit, which is not good.
Okay,
not today, but tomorrow. The trajectory that
you want me to say the quiet part out loud?
Yeah, go ahead.
Yeah, the way you get out of this is not austerity.
You grow your way out of it?
You grow your way out of it. I mean, and I'm sorry, there's a little inflation involved in that, too. That's the quiet part out loud.
Well, I mean, that's clearly their belief, is that you can deficit spend your way out of it because you would ignite a level of growth that would eat into the deficit and get it off of this train wreck trajectory.
No, I mean, that's the key question, right? As to if the growth is there, and I think the leading indicator is going to be the bond market. And when your 10-year is now 4.4 and kind of on the cusp, when you were talking about this tax bill, if the tax bill comes as where it is, the 10-year might move up, and that will have an effect on the stock market. So in the short term, I think you're going to expect a lot of volatility.
Bryn, how much of this matters? The market knows a lot of this already. And as I said, what are we, 2.5% from a new high on the S&P? I think there's like trade war fatigue, tariff fatigue, warning fatigue, Diamond, Dalio. It's like, okay, we get it.
Yeah.
We're 2.5% away from a new high on the S&P. Can we get there in the face of all of that noise?
As long as the bond market lets us get there. And I think that's where ultimately that will be the judge and jury around deficit spending and what the market is, the bond market, not the stock market, will I think, solve that equation. Obviously, you have Ron Johnson, Rand Paul, other senators that are saying, are doing the work that we're all talking about. And so I think the bond market is what to watch. But I do think this wall of worry we're climbing, that we're a whisper of at an all-time high. I think that I'm in the consensus, which makes me a little nervous, that everyone feels like we're in this range-bound market between 5750 and a little bit over 6,000. And so I do still think, though, that the pain is on the upside, because people, I'll say, not retail investors, not our clients, but a lot of people, institutional investors, are underinvested. And so we'll see what happens. But to me, I do think we have trade fatigue, absolutely. And I will say within the numbers, what we haven't talked about are the JOLTS numbers, that the JOLTS numbers actually yesterday came out better than expected, or however you want to look at it. And so unemployment is low. There are more job openings than were expected. And so as it relates to, Trump and Powell, I just think he's barking up the wrong tree. There's really no data that says that he needs to cut right now. And the tariff uncertainty is just going to even push that out further, unfortunately.
Right. Well, I mean, the person's policy is the thing that's lighting the fire that's hurting the economy, and that same person wants the Fed to come to the rescue of the policy that has caused the uncertainty to begin with. I mean, that's the irony, obviously, of the whole thing. Irrespective of any of that, I don't want to spend the next 20 minutes talking about trade, tariffs, and all that other stuff.
Okay, let's not do that. Because I think
there's, we're 2.5% from a new high on the S&P. And technology has been ripping. That trade is back in a very big way. And so if I think we're getting to a new high, where do I want to ride that? What's the goal here?
Well, that's the current episode of how the market gets to the all-time highs. And it is really predicated on, first and foremost, the momentum factor. I think I've come on the show multiple times in the last week and talked about names like Netflix making a new high, like Axon making a new high. I talked about Dash yesterday as a final trade. So it is very much the same equity names that are powering the market higher. What we're benefiting from is, in addition to those names, like Broadcom, which is moving higher today, it is semiconductor names that have not participated over the last 3 to 6 months. It's semiconductor names in which positioning was reduced dramatically. The momentum factor moved away from the KLA Corp, the Applied Material, the Lam Research.
But there's momentum back in the semis. Semis are up.
The momentum is back.
Semis are up 15% over the past month.
So there is near-term momentum back in the semis, and that is what the market is benefiting from, in addition to the momentum names that have been there for the last 6 months. Now you have the added benefit of, okay, let's go back into the semis. So I keep suggesting it's very important to watch the semis. This afternoon's Broadcom report is very important. Does capital go out of Broadcom into a name like AMD, which has struggled over the last 6 months? Can the semi momentum carry forward over the next several months? And if it does, it's one of the primary catalysts, and we'll look back and say that's one of the reasons why we achieved all-time highs.